Peter Major talking about being concerned, cheap money, excess liquidity. Yeah. I can see you're going to
worried about that guy now.
Why?
I'm worried about Peter. I mean, I think there's...
But you're an eternal optimist. You shouldn't be worried.
Yeah, so he's talking about alarm bells and like things going off in the night and like reduce market exposure, run to cash. He's reading stories about the University of Texas and their idiot long-term asset management strategy. You know, but you know what? I actually love it. I love it that people are bearish, and I love it that they are negative and worried about the world, because what it does is it makes asset prices cheaper for the optimists, like myself. So we can be loading up on quality stocks at times like these and making, you know, 100% over 2 years kind of profits because the bears are in hiding. So...
What I'm going to say to you is, if you're wrong, Paul, and Ben Bernanke, a lot of focus on him tomorrow.
If I'm wrong and the world economy is about to collapse, come apart,
I'm going to get you on with Peter Major, and then you guys can talk it out on air and discuss it.
But I'm never wrong. I'm never wrong. I mean, I've been wrong.
You've been wrong about PPC.
But I'm never wrong, because over the last, 5 decades, if you've been invested and you've been avoiding getting out at the bottom, you've made good money. The people who've been... trailing market's average performances are those who think they're a genius and like to time the tops and like get scared at the bottom.
Don't you think it's a different scenario now, because we've got excess liquidity, we have the printing press perhaps overheating at some point, and when the printing press does stop and we don't see the buying of US bonds, again I allude to the same thing that I've been talking to you about for quite some time, those US Treasury yields will shoot through the roof and we'll see a drop in commodity prices.
But you've been reading the same stuff by these crazy tinfoil hat brigade people. All they do is they write up this stuff and they talk about excess liquidity and, liquidity supernova and so on. There is nothing wrong with the conduct of monetary policy. On Wednesday, we're going to have Ben Bernanke talking about what it is that happens as QE2 passes. But if the world was about to end, we wouldn't have had equity markets rallying to the extent that we had. If there was any certainty about these negative outcomes, they would be reflected in market prices. They're not. There's a question mark for me about why it is that so many people who follow the market are so negative. I think it comes from a conviction that there is always mean reversion. In other words, when things are going well, like Peter said, when things are going well and profit margins are high, oh no, they must be about to collapse and go back down again. When things are expanding economically, oh no,
Isn't it a good barometer when your hairdresser starts speaking about entering the market, which in fact my hairdresser did actually talk about entering the market. That is when it's overcrowded and you should sell out. Is that a good barometer, Paul?
Well,
I mean, you've been in the markets far longer than
You've got such long, gorgeous hair that your hairdresser has to talk at length, talking about the market. These days, people have got to talk about these things because we're all so much better informed. In 1929, they said if the shoeshine boys are buying stocks, then you ought to be worried. But I mean, this is 2011. Everybody knows about the market these days. Everybody reads the stories. Everybody has a view. So I don't think it's too bad.
Coca-Cola missed its quarterly profit, impacted by the crisis in Japan, coming in at 86 cents a share, missing profits by 1 penny.
Oh, shocker.
And Coca-Cola down on the back of this.
Yes, but the S&P 500 is at a 34-month high, and we know that it's now gaining ground on the all-time highs, which were reached in 07-08.
Yeah.
The reason is because companies like Coca-Cola, which are global multinationals, are continuing to make more and more money in all these other regions. Yes, they missed by a margin, a couple of pennies. But the more important picture, and the reason the S&P 500 is up as we speak, is that Ford had fantastic results.
And that was my next point. Actually,
that was a company that was nearly dead in 2008.
And what's interesting to note, the best first quarter profits that they've seen in 13 years.
So this is a company that people totally decided was counted out. You could forget about it. It's down the tubes. Turns out it wasn't. Turns out people do want to get around in cars. Turns out people are prepared to drive even if gas costs $4 a gallon in the United States. But on top of that, we've got 3M out with very good numbers. And last week we had good numbers from companies that were, variously US-based, globally based, and so on. UPS had good results today, and that's a key indicator in terms of, e-commerce, because they're in the parcel delivery business. So I think we're going to continue to see this. Good profit margins. Sure, people still grumpy and moaning, unemployment, blah, blah, blah.
May I ask you this? If you could take me back to August 2008, when oil hit $147 a barrel, what was your rhetoric back then?
Look, that era, we were already beginning to see equity markets crumble, and oil remained high because you remember there was that discussion about decoupling.
Yeah.
So China would remain strong and that would be fine and they'd continue to consume.
Did you anticipate the market crash though, Paul?
Well,
did you anticipate Lehman Brothers falling apart?
No, you could see it unfolding like some kind of bad horror movie, but the fact was, in our view, the way that the equity market collapsed and there was such an enormous flight to safety was entirely unwarranted and totally ridiculous, and that's why we counseled clients at the time not to be selling their stocks. Because if you were selling them then...
Did you anticipate a massive market crash?
No, we didn't, but I can tell you now there will be more crashes in the future. But that doesn't mean that we won't have a golden era for economic expansion and that in 10 or 20 years' time equity markets will be sharply higher than they are now, by multiples.
The reason that I ask you this is, you know, I speak to the bears on a day-to-day basis and the bulls as well. And if you stick to your rhetoric for long enough, you will be right.
Except the bears won't be right in the end.
Their own book as well.
Because if you were a bear in 1950 and you're still waiting for equity markets to go back to those levels, then you'd be wrong. Combination of a little bit of inflation, technological improvement, and economic expansion always translates into higher equity prices, unless you're stuck in the companies that go out of business. That's the key.
Absolutely. Okay, well, going forward, I mean, Paul, what are you looking at with regards to shares and stocks that are offering the most value at this point? And don't give me the same names. I want some fresh names here.
Well, I think the key issue for the week is, will Bernanke's performance be more impressive than the royal wedding? I mean, everybody's waiting for Friday.
It's not the question
going to be
but
huge, you know, but I think we're going to have a fairly low volume time of it here.
Yes.
We've got to see how the rest of the US numbers come through. But there are a couple of standout stories. I'm very excited. I know it's a total small cap stock, but this company, Centula, which is going to be taken over by Shanduka Coal. Shanduka Coal is Cyril Ramaphosa's thing, and they in turn have Glencore as a big co-party in terms of one of their coal mines. So that's interesting because it means that Centula's gone from a lost case to potentially part of the Glencore field division. So, I mean, that looks interesting to me. On the local front, I don't know. It's all about just, you know, sticking with quality and bumbling along and, you know, keeping everybody invested.